And so we believe very, very firmly that anyone can be an entrepreneur.
If you just bought and held the top 10 stocks from today and you held them for 10 years, I guarantee you'd more than double your money in the 10 years.
Wow.
Hello, everyone. Welcome to another Wealth Within School for Startups radio update. We're excited to talk to you about the market, the stocks, and everything that's going to help make you some money. I am Jim Beach, and with me, as always, is Dale Gillum of wealthwithin.us. Dale, good to see you. How are you doing today?
I'm fantastic, Jim. I love the market when it's a bit volatile, so I've got to be good, don't I?
So you and I actually spoke exactly 24 hours ago, right as the Super Bowl was starting, and things looked down in the market. We were down 1.5% over the previous week. But today, Monday, we had a good, strong day. We came up a couple hundred points, got a little bit of our drop back. What do you think about the market where we sit right now?
Oh, look, I still think medium term, even long term, the market is bullish. But I know people are, you're seeing articles out there saying, it's been the longest bull run. It's got to finish sometime soon. But nobody knows. There's no big bell that rings when the bull run's finished, and there's no big bell when the bear market finishes. And really, you don't really need to know for that point of view, if that makes sense. Is to me, nobody rings me when stocks they own are rising. They only ring when they're falling. And to me, as long as you protect your downside, like having brakes in a car, you need to know that when you put your foot on the brakes, it stops. But while it's going, you just let it go at the moment. So right now, I think the market's looking good. I think short term, we're going to get more volatility, especially while reporting season's on. I think the volatility will last to the mid to probably the third week of February. Then we'll settle down from there and go nicely. So nothing too much to worry about.
Well, today was actually an interesting day. We had some earnings reports come out today. In particular, Alphabet, Google missed. For the first time, I think, in 5 or 6 years, they were not what we had expected, but yet the market was still up for the day. What do you think about the earnings season overall and Alphabet in particular?
Yeah, I was actually expecting Alphabet to be slightly higher. I mean, obviously the tech stocks drove the market in the last quarter of 2019, especially obviously with Apple as well, and Microsoft was up quite strongly in the last quarter. They've reported positive earnings or better than expected earnings. So I was expecting Alphabet to do as well, to be strong as well, and that's quite surprising to me. I haven't seen all the reports today. I've been asleep here in Australia while you guys have been checking all the reports, so I haven't caught up with all of that yet. But right now, earnings season's been great. I mean, roughly up till the Friday last week, roughly about 40% of companies in the S&P 500 had reported, and as I said, Microsoft, Apple, Intel were leading the charge. But I mean, this week, not just Google, we've got Disney, Ford, GM, Qualcomm, Berkshire Hathaway, and Uber all reporting this week, expecting Disney to report well. Berkshire Hathaway, their B shares are reporting this week. I expect them to do well. I expect Uber. Uber hasn't made money yet, so it'd be interesting to see what they do. But I'm probably a little bit more interested in Ford and GM because they've been more bearish over the last few years as stocks, and obviously the car manufacturing industry has been pretty hard hit, and be interesting to see what they do and whether the news of the US-China trade deal with the phase 1 being signed, whether that's going to help them in terms of getting some trade going with China. But right now, I think the reporting season's great. I think now we can expect it to keep continuing some good positive news. So that's why I think this downward move's only going to be short on the S&P 500, maybe another 2 weeks-ish. Probably between 3,000 odd points and down to 2,900, maybe 8 to 12%. I think that's all we're going to see in the dip. And it may only best be 8%.
All right. So while you were asleep, the last I heard about an hour ago is that about 70% of the reporting data that's come in so far beat expectations. So we still have a significant number of the companies beating expectations. And Uber, just to let you know, you're right, they've never made any money, but they're going to make it up on volume, Dale.
How do you run a company
Uber,
when you don't make money?
Yeah, I love to hate Uber, just like I dislike Tesla. I like Tesla. I just like to make fun of them. And of course, they're now worth more than Ford and Chrysler and GM combined, I believe. But Uber is just a company that I don't know how anyone can be upbeat on Uber. The goal is to put every single one of their non-employees out of business and replace all of their employees with automated vehicles, and they never make money. And they're sexist and racist and elitist. I just don't see the company ever surviving. Is this one? Are we going to argue about Uber like Tesla, or are we going to agree on Uber?
Oh, I think we're going to agree on Uber. I know we had the tech boom back in the early 2000s, and there were a lot of companies then that were rising quite strongly. We're not making money, and quite a lot of them went broke. Now, I'm not suggesting Uber's going to go broke, but I think, there's a lot more competition in the ride sharing space that has come in the last couple of years, and some of those are taking a significant share off Uber. But if you don't treat your employees, so to speak, or your Uber drivers well, they're going to leave you in droves, and then what have they got? Because they're not going to be able to roll out driverless cars tomorrow. They still will need their drivers, and I think there's a lot of drivers right now that are moving to other ride-sharing companies that are looking after them better. But again, I don't know. Maybe people like chatting to the drivers. I know when I'm in the States and using Uber, some of the drivers are great to chat with.
And now it's interesting, they can give you a score as well and say that you were a bad passenger. You weren't fun to talk to. So, all right, let's back up a little bit and go to 30,000 feet. You would say that the stock market right now is performing normally, that normal things are going on, and you have quite a list of these. Go through right now some of the indicators that you see that show us that the stock market is behaving very, very rationally and in accordance with historical patterns.
Yeah, look, when I talk about the market, it's about being realistic and saying, well, what is actually happening? And most people on the market, they invest or trade on speculation, not actually confirmation of something. And a lot of people don't understand how the market unfolds, and so they listen to the noise that the market's making. And what I mean by market noise is all the media out there saying, the wall of worry, what we talked about last week, or all sorts of myths and etc. And that the coronavirus is causing the market to fall. But every year, I know with 100% certainty, I've studied the Dow right back into the early 1900s, and the FTSE right back to the same, and obviously the Australian market back over 100 years. And every year, every market has a high and it has a low for the year. That's just what happens. So you can't change that for 100 years of history. And every year the market will fall into those lows somewhere between 8 and 12%. That's what it always does. We all know that there's a business cycle in the market, and as a business expert, you know that yourself. The market has 4-year cycles, and so the US market has 4-year cycles. The Australian market's around about the same, around 4 years, and it does that from low to high to low. Right now we're not coming into a 4-year low, but since the 22nd of January this year, the S&P has only fallen 3%. Well, it's actually less now after today, but the fall, as I said earlier, I think it's going to last about 2 to 4 weeks, all up 8%. We'll probably see it get to just below 3,100 points, a 12% fall, about 2,900 points. But we need to look at from a little bit of history, more recent history. From May to June last year, the S&P fell 7.5% in 4 weeks. So what's different now? In January 2018, the S&P fell 11.84%, so 11.84%. It did that in 2 weeks. What's different now? In December 2018, it fell 20.21% over 13 weeks. So that was a bigger fall, and that was probably a 2 to 4 year low that we were expecting. So right now, everything's normal. So the current dip really is just simply because the market was quite bullish from October, and we saw Apple and some of those other big companies in the tech sector really pushing the market to new highs, and it was just a bit too bullish because it rose 12% in 78 days. So that's quite fast. But to me, what's that old saying that they talk about in the in the UK? So I mean, stay calm, everything's fine.
Well, Dale, you add all of that up together, and it sounds like we're due for another small correction in the course of the year, which, as you point out, is exactly normal and average. And it sort of reminds me of a falling expression, your strategy of not trying to pick the bottom and trying to you're not invest based on speculation. All of this reminds me of the expression, not trying to catch a falling knife. How does that expression go exactly? Don't catch a falling knife?
Yeah, you got it out, Jim. It's very much so. It's about not catching falling knives, and it's almost a bit different than dodging plates with your wife, you know.
I wouldn't know about that. I know nothing about that.
Yeah, well, I find a lot of investors, with the markets volatile, that a lot of investors actually make knee-jerk reaction or emotional decisions, and they do things like dollar cost averaging as their stocks that they own are falling, they keep buying more. But you never really know when the bottom is, and the sort of saying a little bit earlier when I said, nobody rings the bell at the top and nobody rings the bell at the bottom. It's the same for a stock as the market. So you just might have a stock that you keep buying and it keeps falling, and that's what we calling catching a falling knife, and you do get burnt most of the time. But in times like these, you're better off if you've got good stocks. That's why I talk about having stop losses. If they fall a little bit too much, you get out and you move on. But having good stop losses allows you to stay into a stock so that you can take a rise from there. But right now I think it's another, this part of the year, we've probably got maybe 1 to 3 more weeks down, probably more like 2 to 3. A few more 100 points, maybe down about 8% pullback, maybe 12% at best. And then we'll be fine. But I think that the market is looking good for the year. I don't think the S&P is going to do another 25 or 26%. But hey, I could be surprised. It could do it. But right now, everything's looking nice. Don't panic.
Great advice, as always. Thank you so much, Dale. Find out more at wealthwithin.us. Dale Gillham, thank you so much, and we will talk to you again next week.
Thanks, Jim.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services license, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
It seems like every week I'm actually saying it's an interesting week on the market, or wasn't this week interesting, or the volatile, and it just seems to be a constant nowadays. And obviously that double-edged sword with the internet, which you talked about a little bit earlier, it really is at play. I mean, obviously the US market, or the US is in reporting season right now, which goes for it's all this week and all next week through to mid-February. And whilst reporting season's on, which happens 4 times a year, you're going to see more or increased volatility in the market. And when there's increased volatility in the market, then we get emotional decision making by everybody because of all that market noise that comes out around stocks and around the market itself. So, but let's go and have a look at some reality and look at the chart, because the chart really does give us reality, and there's no there's no bias in the chart. There is absolutely no different opinions. It is what it is, because the chart, when you look at any chart of any stock, the data comes from the exchange. It's unadulterated, unmanipulated. It just is. So whatever something traded at is what it is on the chart. And so what you're getting there is it's not biased by individuals or situations. It's just telling you how much buying and selling is happening on a market or a stock at any one time. So you're knowing that that old economics, the supply-demand chain. What is the balance there? If there's more buyers or more sellers, and how voracious are the buyers and how voracious are the sellers, so you can determine the momentum and the volatility and actually make better decisions for your portfolio. But let's go and have a look at the Dow Jones now on the chart. Now this chart on your screen right now is a weekly chart on the Dow Jones. Now some of the thing is you look at this, the market, if I just draw that up a bit, you can see here there's a low there in August. We had 1, 2, 3, 4 bars up, 1, 2, 3 bars down. Here we've had 1, 2, 3, 4, 5 bars up, 1 down. Here we had 1, 2, 3, 4, 5, 6 bars up, and now 2 bars closing low. So what's unusual about that? You know, if you go back here, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9 bars up, 2 bars down. That's what the market does. And that's really what I'm saying is the market does what it's always going to do. It was overdue to pull back 1 or 2 weeks. That's normal. But also when we do it on a larger scale, and you can see these bigger moves down here when we see the market is ready for a yearly low or a 4-yearly low or an 8 or 10-yearly low or a 20-year low, it'll have bigger dips, and you can see that. But all the market was is coronavirus or not, it was going to fall regardless of a coronavirus. It just gave the market an excuse to push it down a little bit. If we look here from this bar here, which is November, end of November, you can see it rose 4.71% in December and through into January there, because obviously that high there is the week in the middle of January. So 4.71% is pretty good, but if you go back, it rose pretty well on some of these other months as well. But right now, I do expect the market to fall away. I do expect the Dow to fall sort of back in line where it was before, because momentum ebbs and flows on the marketplace. So if I draw something like that, that's roughly the momentum on the Dow. It keeps moving up and coming back down onto this line. And that's all it's doing. Now, it may drop below this line and we may see the Dow drop a few more points. I'm expecting somewhere between 8 and 12% max for this move down on the Dow. And if I draw that on the chart here, and you can see there from the high, if I go down there, there's 8% is roughly around that level at 20, just under 27,000 points-ish. And 15% would take you right down to that level of 24,000. But I'm thinking maybe 12-ish% would pull it right up here, and you're talking about just sort of 25,800, but it's just bringing it back down into this sort of area here where there's a hell of a lot of support for the Dow. So again, what I'm saying to you, don't worry about the market. The market is bullish. I think the Dow will continue to be bullish despite all the market noise, despite all the doom and gloom. I think there's another probably couple of years up on the Dow overall, and this bull market will last a bit longer. If you're making emotional decisions and you're following the herd, then you're constantly going to get it wrong. So to me, it's about understanding what the market's doing, get it to confirm what it's doing, and make your decisions. But I'll tell you right now, as I never make a decision on a stock by looking at the market. To me, it's irrelevant what the Dow or the S&P or the Nasdaq's doing. I just look at the stocks, and the stocks tell me to buy and sell, and that's what I look at. I don't actually look at the market. The market's a nice barometer of what the overall emotions are on the market, so it will tell you whether the stock that you might be buying or you're holding might be more volatile or might be a bit more, won't rise as fast or might fall a bit faster. That's what the overall market will tell you. But it doesn't tell you to get in or out of a stock, so I don't make decisions to exit stocks in my portfolio because the Dow's fallen, so to speak, because of a coronavirus, which is already, the market was already falling anyway. So what I want to do is get into some really cool stocks. I wanted to look at the stocks that are reporting this week, just so you can have a look at the charts of those, and then we can have a little bit of a discussion what the expectation might be on those stocks. So let's go and look at some of those stocks right now. Now I'm going to put my glasses on here so I can actually see everything for you, but the stocks we're looking at the moment for this week, or reporting this week, or the big ones that I've picked out are Google. I'm looking at Disney, I'm looking at Ford, I'm looking at GM, I'm looking at Qualcomm, I'm going to be looking at Berkshire Hathaway B shares today. So looking on the screen right now, you can see Google or Alphabet. It's just massive. It's just been beautiful trending stock, and right now we've seen on the right hand side that weekly chart, it did turn around here in that last week of February, dropping down a little bit, a bit of indecision here, but it really is just nice. I would expect Google or Alphabet, like a lot of those other tech stocks like your Apples, your Microsoft, to report good earnings. And I know Apple and Microsoft have already reported they were slightly above expectations. Right now, about 3/4 of the companies reporting, as you know, are reporting better or slightly better than what everybody expected. So everything is auguring well for a good market. Right now, I think the volatility is just really, really short term. Again, this is just moving up nicely. If you look at this, if I put a trend line on here, you can see the angle of this. And that's all that's really, really happening here is the market. If I can grab that. And it won't grab it for me. Why isn't it grabbing it for me? Let me click on here. It's one of these things you can't get things when you want to work it. There you go. Look at that. So this stock runs on that sort of angle. You can see the angle that it's moving up on. That's all it's doing, is keeping that same momentum, and it does fall. You can see it falls all over the place. Rise up, fall, rise up, fall, rise and up, fall. This is normal market behavior. Alphabet was just, or Google was just running a little bit hot for the last couple of months. So it's just readjusting its momentum back to what's normal for this stock. Let's go and look at Disney. There was a lot of conjecture with Disney about how it would go against Netflix and what was going on with all that streaming services. Disney Plus has been out now. I actually subscribed to it for a couple of weeks just to have a look at it to see what it is. Obviously, it's a lot of Disney movies, which is not necessarily my how do I say it? Not to my like. I like Disney movies, but I don't have kids, around to watch all these movies with. So it's not really a service that I want to continue to subscribe with. But I thought it was a great service, what they're doing, and the website and everything. The apps look really, really great. But Disney's gone up beautifully again. It's gone up very, very strongly right through here. And again, it's just coming back, I think, just to what's normal. And if we look at that monthly chart, you can see how nice that Disney moves. And again, I'll put my little, using my trendline tool in here, and I'll just go up. Not the wrong tool. Let me trendline tool. The other one. I'm having a great day today, aren't I, guys? But it's just, you can see that momentum is just around that sort of line. It moves up and back and around that line. It's just coming back around here. That's really all it is. It was overheated a little bit. Its momentum just slowing again. But looking at the weekly chart, this stock's been falling since November. So coronavirus or not, it was already falling. Nothing. And this is quite interesting how you got this beautiful big gap down here and it's moving up to fill it, which suggests to me the big end of town do like Disney. Again, I used the wrong tool, guys. Where is it? There we go. I put my glasses on and I still can't see. It fell 3% between the close on the Friday and the opening on the Monday of last week, and it's just filling that gap. So this run up here will tell me what's happening with Disney, whether it's going to be more bullish, more medium to longer term. I do like this stock. I still think it should be one that you'd look to put into your portfolio. Now let's get on to a couple of the car manufacturers, Ford and GM. Now I don't expect either of those to be having great reports because at this point in time, but needless to say, with the US-China trade deal going through in phase one of that, these companies may benefit a little bit from that, from auto importing or exporting from the US into China and opening up some of those sorts of things. But right now, again, both of those, Ford doesn't look that super bullish to me. It still looks pretty bearish. It's not solid, but they're getting a lot of competition. Obviously, with the hybrid cars, your Tesla is doing very, very well at the moment. There's a lot of competition from overseas manufacturers doing it cheaper. But Ford's has done very well at different times. I mean, here's your low back here in 2008. You really haven't done well if you'd own Ford in this particular time. I'd like to see it start to move up. If it can start to move up from here and get through that sort of $10 mark to $11, then it might be on a new bullish move over the next medium to longer term. But should it start to fall through this sort of low here at 844, then I'd suggest the down move hasn't finished yet, but it's not looking healthy. But let's move now on to GM, another car manufacturer, as you know, and these two are some of the oldest companies in the Dow. Again, this thing looks very, very bearish, a lot more volatile than Ford. Obviously, GM, it came out of, I think it was Chapter 11, I think it's called, way back there in 2010. It went bankrupt with the GFC, but it is looking bearish at this point in time. And so I'd like to see, hopefully that, as I said, that US-China trade deal will turn these couple of stocks around and see them having better fortunes. And I'm mildly confident it will. Right now, I'm staying right out of those, and I'm not suggesting people get into them, but just be careful with them. Some of the stocks I've been looking at more recently and been promoting probably for the last 4 or 5 months is these chip manufacturers, your Intels, your Qualcomms, which is on your screen right now, Nvidia, those sorts of stocks, and they've all done very, very, very well. And Qualcomm has done excellent. And again, See how big this move was for Qualcomm, and from this low here down in January last year, it hit up 91% in 2019. Then it reached right up to 95, but currently it's about 73%. But you can see the angle where that's on. All I'm suggesting is it's just coming back to normal momentum. So I'd expect some more downside on this stock. But again, moving forward, I do like it. I still think it's a great stock. It's just a lot more volatile, so you need to have better rules on it than you do on other stocks. One of the other stocks that a lot of people love to talk about is Berkshire Hathaway. And again, Berkshire Hathaway had its high here back in mid-January. It fell away through here. But let's look at that monthly chart. Let's go back here. A beautiful trending stock. And it really is nice. You should be just holding this stock. It's one of those stocks you can almost buy and hold, because obviously Buffett knows what he's doing. Right now there's no reason to panic, but I would expect Berkshire Hathaway to have a good report. I'd expect Qualcomm to have a good report. I'd expect Disney to have a good report. I'd expect Google to have a good report, just like Apple and Microsoft. But Ford and GM, I'm a little bit iffy on whether they'll report good. As long as the report for GM and Ford aren't too bad, if that makes sense, if they're sort of in line with expectations, then it could all go well for a good 2020 for them and beyond. And that's why I'd stick them on my watch list just to watch to see if they do find some support and start to move up. But again, as I said, I do like the chip manufacturers as well. But that's it for me for this week on my stocks analysis. But if you have a question that you'd like me to answer, just stick them below. There's a chat thing below, and I really will answer those. If you have a stock in the US that you'd like me to talk about, analyze, bring up the charts, please do that. So if you stick your fingers on the keyboard and type, I'll start answering more questions. Now remember, I do these reports every week, so hit that subscribe button now and click the bell on the right of it so you know when we go live with our latest stock market reports. But for now, I'm Dale Gillen, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.